Now, I would like to look at the other forms of risk that could typically play a role in the structured products. Especially, I would like to look out for three major forms of risk in this regard. One is the systematic risk, just like equity portfolios. Even you do any amount of diversification, the systematic risk cannot be eliminated altogether. The same logic applies even with the credit portfolios, and that systematic risk will be much higher, especially if the pairwise correlations between the various loan securities in the pool increases. But if the correlations come down to a large extent, the systematic risk can be reduced, but it cannot be completely eliminated. So pure diversification based on the lender or diversification based on the geography. Sometimes it is heard that if a company or if an entity defaults in state X, it's not mandatory that a company in state Y has to default. So, but in some cases it may act like a cascading effect, wherein the likelihood of default increases as one of the companies in one of the geographies default. So we can create a pool with as much of diversification as possible, but still some kind of risk can definitely exist, which is what we are calling as a systematic risk. And as the correlation between the individual securities increases, we are even talking about the write-offs typically happening. And at the same time, I can also look at the thinness, especially for equity and mezzanine tranches. Their volume is very less. So what we typically see is once the barrier is breached, once they have to absorb the risk because of very small amounts, because probably if the portfolio is 100 million, probably the equity tranche would be just 5 million. So even if the loss is 1 million, equity tranche is absorbing almost 20% of the total loss. So that is where the thinness will create a risk. So the 90, there will not be much of a difference between your 95% VAR or 99% VAR. So once the tranche, the limit gets breached, the loss is going to be pretty tremendous. So that is one more risk that needs to be looked at. And the other dimension is loan granularity. Typically here, what we see is the assets that are there in the pool. We see few loans with high individual size. So even if one of them defaults, the impact is going to be much higher. But when we talk about the other way, large number of loans but of small amounts, the overall, the total worth of the portfolio is going to be same in both of them. But here the risk is much higher compared to this. So that is what we are associating it to the loan granularity related risk, right? And now I am also looking at a couple of other smaller important contexts. One being an implied default correlation, means implied correlation between the various loan assets that are there in the portfolio. The same, just like the way we have computed implied volatility using the Black-Scholes pricing model, we can do the same thing to arrive at implied default correlation, as well as trying to arrive at implied I mean the same kind of a process which we use for the Black-Scholes model to arrive at implied volatility by picking up the market-based prices and equating it and finally deriving the implied volatility. Similar kind of an approach can be followed even for arriving at your implied correlation also, because Correlation is nothing but covariance divided by the individual standard deviation. Now, individual standard deviations is what we are deriving using our Black-Scholes model formula. So, a similar kind of an approach can very well be arrived at to derive our implied correlations also. And when I talk about what is the key motivation, right? Now we have talked too much to a large extent on the various aspects of the structured product. Just a quick summary to the end. What is the key motivation behind going for the structured products? When we talk about the loan originators, especially the banks or any lenders, they sell the loans to a trust. So this gets help. This gets the creation of the securitization process itself, and they are attracted to the secured borrowing process through the securitization because it provides a low cost funding. So one of the major advantages I see is cost of funding becomes much lower because you can pay very little interest rate to the investors. So the cost of funding, especially with the senior tranches and all, because of low risk associated with them, the amount or the interest or the coupon that can be paid to that tranche will actually come down. So typically the cost of funding will come down rather than retaining the loans. The liquidity can very much be promoted in the overall system, and investors are purchasing the various bonds and they are investing in the equity in the securitized process. So it gives them some kind of an exposure to the credit linked products investment, which can add diversification to their portfolio, and they are investing in a diversified loan pool rather than getting a direct access to some real estate investment. They are investing in some kind of a diversified pool of loans and bonds, so which rather than directly investing in those particular real estate or property markets where they are getting exposed more and more to the various forms of risk. So from the creator's perspective as well as from the investor's perspective, there is a lot of demand that is getting created for the structured products, and that's the reason the structured products market is growing by leaps and bounds in the financial space, right? So this is what I would like to cover as a part of the complete understanding of the structured products and the credit risk associated with this structured products. If you have any further queries or clarifications regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.